Hi everyone, welcome to the new module. In this module, we will cover more about the functioning and management of banks. More specifically, in this session, we will focus on the features of bank balance sheet. So, while going through bank balance sheet, we understand how does a bank function. Okay, right. So, just about importantly we will be covering how do banks function and what are the how do they attempt to maximize their profits. So, one of the point I would like to highlight here, although the discussion that follows focuses primarily on commercial banks, however, many of the same principles it applies to other financial intermediaries as well. So, first of all, what's a bank? So, bank is a financial intermediary and it accepts deposits, that is one. Then using that proceeds is lent to the needy, including firms, government and consumers, right. And it is a profit maximizing entity as well, like any other firm. Bank is also a firm, it tries to maximize its profit. So, while doing that, a banks engage in an important function is called asset transformation. So, about asset transformation means it's a process of selling liabilities with one set of characteristics, that's including a particular combination of liquidity, risk, its size and return, and using that proceeds to buy assets with a different set of characteristics. If I give you an example, suppose selling liabilities, that means accepting deposits. So, look at a savings bank account deposit that almost all of you are having with a bank. So, what is the nature of deposit? And you know that, look at the particular combination which I just now I mentioned here, that means the liquidity of bank deposit, that means it's a liquid asset for you, though it's a liability for the bank, it's a asset for you, and you know that is highly liquid. And about the risk, actually as compared from your perspective, the risk is very less, and the size, most probably the size is small, and the return that you are getting is also small. Now, let us see, using these proceeds, that means using these deposits, what a bank will do. Bank will be, one example I can give you, it will be giving a loan. It will be giving a loan to a firm or to a government or to a consumers. Then at that time, the characteristics of the same money, maybe the same fund is now became another security, that means it became an asset, that means a loan given to different people, different entity. So, how does it look like now? The liquidity of loan as compared to a bank deposit, a bank loan is least liquid for a bank. Suppose you got a loan from a bank and bank cannot immediately ask you, just pay it back, right. So, in that way, a loan, the same fund, but it became a loan, now it became less liquid. And again, the risk of bank loan, you know, the default risk is normally very high as compared to deposit, the risk has increased. And about the size, normally maybe your deposit, it may be for 1000, 10,000 or maximum 1 lakh maybe perhaps, but a loan maybe, you know, that is in big, huge in size, particularly when they are paying to firms and government, and it will be in lakhs and millions, right. So, that means what the bank is doing here is that they engage in the process of asset transformation here. So, that means using these proceeds to buy assets with different set of characteristics. This is one of the important function of a bank. So, in this process, bank actually engage in an activity of called borrowing short and lending long. That means borrowing short means the deposit, most you know that maximum the expiry date, the time deposit, it may be for 1 year, but banks lend it for long term, that is for 5 years, 10 years, like that. So overall, to summarize here, so we can see that a bank means it does mainly two groups of tasks. One is transforming assets that we discussed, and the second one is providing a set of services including check clearing, record keeping, credit analysis and so forth. So in this way you can see that a bank is also like any other production process, the way they engage in a firm. However, we need to remember that unlike other firm, a bank is considerably different from how other firms work. That we will cover in today's session, this session and the subsequent session. We will be covering how a bank is different from other firms. So now in order to understand a bank, what a bank does, what we do that we will go through the balance sheet of a bank. So in the balance sheet, I am sure you are familiar with the term we normally use, liabilities and assets, right. When it comes to bank, how we equate that the total assets of a bank is equal to total liabilities plus bank capital. So coming to the liabilities means the sources of funds for the banks, and assets means the uses of these funds. So look at this balance sheet of all commercial banks in the US. So I am sure that this will give you a fair idea how does a bank balance sheet look like. So look at this. On the left hand side you can see reserves, securities, loans, etc. And on the right hand side you can see checkable deposits, non-transaction deposits, borrowing and bank capital. So this is an overview of the bank balance sheet. So what we will do in the subsequently, now we will discuss one by one. In that way, by discussing each of these, we also get to know what a bank does. Okay. So let's start with the liability side. So in the liability side, you have seen that the checkable deposits, non-transaction deposits, borrowings and bank capital. So let's go through one by one. In the case of checkable deposits, so it's one of the important liabilities for a bank. So in the checkable deposits, and as the name is actually payable on demand. And why is called checkable deposits? Because checkable deposits include all accounts on which checks can be drawn and allow the owner of the account to write checks to third parties. So this is important, that is about the checkable deposits. And it's a liability for the bank because that depositor is entitled to get this money from the bank. From bank perspective, it's a liability. So in this case, that depositors can withdraw funds and bank is obligated to pay. So this checkable deposits is also called as demand deposits because the depositors can withdraw this money at their demand at any time. Okay. And it's an asset for the deposit, just we mentioned that is a part of his or her wealth. And checkable deposits are one of the lowest cost source of bank funds. Why? Because depositors are willing to forego some interest in exchange for access to a liquid asset. Plus they also get bank services. They can keep their money with the bank and they get the banking services and they get easily access to a liquid asset. So because of that reasons, banks that depositors are also willing to forego some interest. And what are the costs of maintaining a checkable deposits? So that one is actually the interest payments, that actually all of us will be getting some interest when we have some checkable deposits. And the second one is incurred in servicing these accounts. That means processing, preparing and sending out monthly statements and providing efficient tellers, be it human or be it the ATM, automatic teller machines. So maintaining an impressive buildings and conveniently located branches and advertising and marketing aimed at enticing customers to deposit their funds in the bank. So these are all the costs included in servicing these accounts. Okay, so these are the two important components of the cost. So let's now move to the second component, is called non-transaction deposits. So non-transaction deposit means owners cannot write checks on non-transaction deposits. And here normally for a non-transaction deposit, there is a time is there for the withdrawal, is also called as time deposits. So because of that, the higher interest rates are paid on these deposits, and because of that there is a time constraint is that may be for 1 year, like that. So you can withdraw this money only after 1 year. So because of that these are also less liquid than checkable deposits. And you know that when you commit your money in the bank for a fixed period of time, so the bank can utilize this money to pay deposits to the needy people, to the borrowers, right? So they, because of that, a bank also can efficiently use this money, because you are not going to withdraw this money at any time, and because of that they get high interest income, and because of that you also get relatively high interest rate than the checkable deposits. So this is one of the primary sources of bank funds. And there are mainly two basic types. One is savings bank account, and another one is the time deposits accounts. And coming to the savings account, you need to remember, in India savings bank account is also called as demand deposit. It shouldn't be considered as a non-transaction deposit. Instead it's a transaction deposit, or it should be considered as a checkable deposit. So all of you are having savings bank account, so you know that it's highly it's highly transactionable, and it's a checkable deposit. You also allowed to write a check when you are having savings bank account, and because of that is called as demand deposits as well. So in that way when we are talking about Indian context, I should be putting the savings bank account in the first category, that is the checkable deposits. And coming to the second one, that is called time deposits, is also called certificates of deposits. This non-transaction deposits, as I mentioned, that is also called as time deposit. It has, time deposits have a fixed maturity of length. So these non-transaction deposits, time deposits, we can categorize it into two. One is called small denomination time deposits. So this is normally deposits of less than 1 lakh, and these are less liquid for the depositors than passbook savings, and earn higher interest rates, and are more costly sources of funds for the banks. Then coming to the second one is called large denomination time deposits. These are available in denominations of more than 1 lakh or more. And these large denomination CDs are negotiable as well, is also called as NCDs. It's just like bonds. They can be resolved in the secondary market before they mature. Otherwise, the time deposit that we are all having with the Indian banks, they are actually not negotiable, non-negotiable in fact, because the deposit, that the time deposit that we keep in our Indian banking, mostly small denomination time deposit, these are non-negotiable, not tradable in the market. But however, these large denomination CDs are negotiable. They are called negotiable certificates of deposits. Okay, so these NCDs are typically bought by corporations or other banks, big large banks. So NCDs are held by corporations, money market mutual funds, and other financial institutions as alternative assets to treasury bills and other short-term funds. Let's now move to the third category, is the borrowings. So this is another important source of bank funds over time. So where all a bank borrows, and it mainly borrows from three sources. One is from the Federal Reserve System, that means in Indian case is the Reserve Bank of India, and the banks borrow from the central bank at a discount rate called as discount loans. And the second sources of borrowing for the bank is from other banks, as is mostly short term borrowing. In order to meet the liquidity and reserve requirements, banks borrow from each other. So these are overnight borrowing, that the overnight loans in the Fed fund market, that means interbank loans, and these are mostly unsecured loans. So the examples for these is include that the borrowing from Fed fund market, Mumbai interbank market, Libor, etc. And the third source is called from corporations. Is mostly from their parent companies, and many banks, they are having their parents companies, and the bank holding companies, they borrow from there, and they also have loan arrangement with corporations such as repurchase agreements and borrowing of euro dollars, that is a deposit denominated in US dollar residing in foreign banks or foreign branches of US banks. So coming to the borrowing, one of the components that bank borrow using the instrument called repurchase agreement, we call it as repo. Repo means a short term collateralized loan in which a security is exchanged for cash. So look at the figure here. So from this, I think you will get a clear understanding how does a repo agreement works. So we are actually looking for 2 days for this transaction. So look at, for example, day one. So in the day one, what happened that a bank who is borrowing, bank sells US treasury bill to pension fund in exchange for cash, right? So you can see that bank selling US treasury bill to the pension fund. So in return, on the same day, bank will be getting money from pension fund. Actually, the bank is borrowing from this pension fund and by selling the treasury bill to the pension fund. In day 2, what they do, that they make a repurchase. That means what the bank will do, bank repurchases in day 2, bank repurchases US treasury bill from the pension fund in exchange for the cash plus interest rate. Okay. So that will happen on the second day. So return to the bank. So in return, bank will be giving the principal plus the interest paid to the pension fund. So this is how a repo agreement works. Now let's move to the last component of the bank's balance sheet. You can see that is the bank capital. Bank capital, it includes equity capital and plus retained earnings. Actually, though we put it in the liability side, actually it's not really a liability as such. However, you know that these are actually equity capital that is raised from the equity holder, and it also the retained earning, the undistributed dividends with the banks, that also become part of the bank capital. So in that way we can also interpret it as liabilities, but as I mentioned, it's not necessarily a liability as such. So you can see that I just expanded this one. You can see that liabilities for bank capital. So bank capital, that is equal to the total assets minus liabilities. So bank capital is raised by selling equity, stocks, and from retained earnings. So later on we will see that a bank capital is its cushion against a drop in the value of its assets, which could force the bank into insolvency. Suppose when a bank has liabilities greater than assets, maybe if there is a sudden outflow of deposits. So at that time we will see that in the subsequent discussion that a bank capital is going to work as a cushion or as an insurance against sudden outflow of deposits. So far we covered the liability side. So let's now move to the asset sides. So the asset side, let's again go one by one. The first one, this is called reserves. So reserves means, actually reserves include reserves plus cash in vault. So what the reserves means, actually there are reserves with the Fed, that the central bank. This is called required reserve, plus cash that is physically held by banks or in their shelf, that is in their vault, held by the bank. That means it's also called vault cash because it is stored in bank vaults overnight. And you know, banks hold reserves for two reasons. One is for the required reserves, because these are held because the reserve requirement, the required reserve requirements, the regulation that for every dollar of checkable and time deposits at a bank, a certain fraction, see for example 10%, for example, must be kept as reserves. So this fraction is called cash reserve ratio, the required cash reserve ratio. So in India is approximately 4% at present. It varies, you know, during monetary policy announcement they will be changing slightly. And so just come to this main point, that means one of the important component is the required reserve, that is called the cash reserve ratio. That means a certain fraction of the total deposit, demand and time liabilities, the banks are obliged or mandated, legally required to keep a certain fraction with the central bank. That is called required reserve ratio. So in the US you can see that is not equal for all banks. For the small banks, for example having more than 16 million to 122.3 million, they are required to keep only 3% of their total demand and time liabilities. And if the bank is having more than this, they are mandated to keep 10% of their total demand and time deposits. And apart from reserves, banks also keep excess reserves. That means any money, because you know that all the banks, they all have accounts with the central bank, with the Fed. So that means what is the additional money, additional reserve in addition to this, in excess of the required reserve. For example the 10%, if in excess to that, whatever is keeping with the central bank, that we are going to call it as excess reserve. So these are additional reserves because they are the most liquid of all bank assets, and a bank can use them to meet its obligations when funds are withdrawn, either directly by a depositor or indirectly when a check is written on an account. So moving to other components of assets, this includes securities. Securities means mainly government securities, so it's also called as secondary reserves, and these are an important income earning assets. And you know that most banks, and one of their important component of their asset is their investment in securities, government securities. In the US there are three categories of securities: the US government and agency securities. These are most liquid and easily traded and converted into cash with a low transaction cost. And then coming to state and local government securities, and also called as municipal securities, municipal bonds. Then coming to other securities issued by large corporations. When they raise their fund through instrument that borrowing from the market, they issue bonds. So these are other types of securities for a bank, where the bank will be making investment. So securities, shortly, this is an important debt instruments for commercial banks because banks are not allowed to hold stock. So in addition to that, in India, we also, the Indian banks, the scheduled bank, they are also obliged to keep statutory liquidity, keep a statutory liquidity ratio. That means every bank is required to maintain at the close of business day a minimum proportion of their net demand and liabilities as liquid assets in the form of cash, gold and approved securities. So again, that means this is in addition to, in India, in addition to the cash reserve ratio, banks are mandated to keep a certain fraction of their total deposits in most liquid assets, that including cash, gold and approved government securities. And you know that an increase in SLR also restricts the bank's leverage position to pump more money into the economy. So these are about the reserve part. So let's now move to the third component. This is called cash items in process of collection. So we can explain this concept, this component, by using an example. Suppose that a check written on an account with another bank is deposited in your bank. Suppose you are holding an account with the SBI and you got a check issued by a person having account with the HDFC bank, for example. So in this case, what is going to happen? So the funds for this check have not yet been received, collected from the other bank. So with the moment when you get this check, what you will do, you will be depositing this check in your bank, in your branch. Then your bank means your SBI. And then what is happened here is that this check, though you deposited this check, but immediately the moment you deposit this money in your branch, in your bank, immediately this much amount will be credited in your account, though it will be written that subject to realization of credit. So what is going to happen? So at that time, this check, though is in your written as in your account, however this actually cash item in process of collection. So it's an asset for your bank because it's a claim on another bank for funds that will be paid within few days. Next item that is called deposit with other banks. That means bank also keep deposit with many other banks, many small banks. Many small banks actually hold deposit with larger banks in exchange for a variety of services, including check collection, ATM facilities, foreign exchange transaction and help with the securities purchase. So this is one aspect of a system called correspondent banking as well. So collectively what we will do, that cash item in process of collection and deposit other banks are referred to as cash items. So this is the fourth component, and the remaining we will cover in the next session. The two more component is remaining, that is called loans and other assets. With this one we will cover in the next session. Thank you.